Hi, welcome to On Investors Minds. I'm Tai Hui, the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management. And thank you for giving us a few minutes of your time to learn about what investors are thinking about right now and how that fits in with a bright portfolio. Last week, I discussed what we've learned so far from the Trump administration, the US Federal Reserve, and also the US economy since April 2nd, Liberation Day. In this episode, I want to discuss the other major player in this tariff war. At the time of recording, China is facing a 145% tariff from the US. It has shown some willingness to negotiate with the US. While this is still pending for progress, I want to address several popular questions from our clients. This includes the potential impact on the economy and Beijing's potential policy response, how the Chinese yuan would behave, and what the Chinese government could do with its US government bond holdings in reserve. Now let's start with the Chinese economy. The economy grew by 5.4% in Q1 2025, beating expectations. But here's the catch. The data is already outdated. Why? Because it doesn't reflect the massive escalation in US-China trade tensions that we've seen in the recent weeks. Digging deeper, there are some bright spots. Retail sales jumped 5.9% in March, thanks to government subsidies for electronics and big-ticket items. But an old challenge lingers. The property market slump isn't quite over yet, and corporate investment remains lukewarm. So what's next? More stimulus is needed if the government is to keep the economy on track for the 5% growth target for this year. With global demand under threat from the trade war, Beijing has room to ramp up spending. Think consumer vouchers, especially for services. It will also need to continue with supply-side policies to support industrial development and facilitate greater adoption of artificial intelligence. Now let's move on to the Chinese yuan. Conventional wisdom says that the trade war means a weaker currency for China. But the yuan has remained relatively stable so far. It has depreciated by 0.6% against the US dollar since Liberation Day. It is behind a number of Asian currencies such as the Japanese yen, the Korean won, and the Singapore dollar. But a massive depreciation, what has been predicted by pundits, has not happened. And here's why. The US dollar has weakened across the board. The dollar index has lost 4.8% in April, and China manages the yuan to a basket of currencies, which means that historically, the yuan appreciate against the US dollar or strengthen against the US dollar in a weak dollar environment. And also capital flows matter. Unlike 2018, China isn't attracting as much foreign investment into its financial markets today. A yuan depreciation could prompt more capital outflow from domestic investors. Hence, the central bank needs to strike a careful balance between countering the negative impact from tariff for exporters while maintaining domestic financial stability. And finally, if China wants to make deals with Europe and Southeast Asia and other trade partners, a cheap yuan will not help. Especially many of these trade partners are already concerned that a flood of Chinese exports could be landing in the markets, and hence a stable yuan could be seen as a sign of goodwill when it comes to negotiation. The bottom line here is that the People's Bank of China may want to prevent a significant devaluation in the Chinese yuan. And finally, let's talk about China's holdings of US Treasuries. Some say this is a nuclear option in trade talks, but I think it's not that straightforward. China wants to be seen as a responsible stakeholder in the global economy and also financial system. Any market turbulence won't only hurt the US if China decides to sell down on its treasury holdings. It could also have a global impact on all China's key trade partners. And therefore, Beijing may want to be super careful in deploying this strategy until it's absolutely necessary. And also, $700 billion in reserves sounds like a big number. But just to put this in perspective, this is coming down from over $1.2 trillion in 2011 to where we are now, and it's only less than 3% of all outstanding US federal government debt. China reducing its holdings could be matched by other buyers such as the US financial institutions, and the Federal Reserve can always act as the buyer of last resort in order to maintain overall financial stability. So taking this backdrop into account, China's ability to pressure the US could be neutralized in the medium term. This implies it may not be the super effective tool to gain leverage in negotiation with the US, there are clearly better alternatives to bring to the table when it comes to negotiation. And thanks for listening. If you enjoyed this podcast, please share this with your friends or colleagues and also consider subscribing. If you have any topics you'd like to hear us to cover, please reach out to your JP Morgan Asset Management client advisors. I'm Tai Hui. I'll see you next time to discuss what's on the investors' minds.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase and Company and its affiliates worldwide.